Hi, welcome to Volatility 411. I'm Russell Rhoads, Head of Research at EQ Derivatives. I'm also an Associate Professor of Finance at the Kelley School of Business, and recently I had a student asking me how could they get exposure to VIX. They had looked at the big VIX Futures contract, the original contract, and it was a little big for their budget. They'd also taken a look at the exchange-traded products that give you exposure to VIX, and they just weren't comfortable with the structure of those. So I turned them on to the Mini VIX Futures contract. Mini VIX Futures has been around for about a year and a half. They're 1/10 the size of an original VIX, so 1 point, or the original VIX Futures. So 1 point is $100 versus $1,000. It's also appropriate for larger traders. It can allow you to scale in and scale out of positions more effectively. And they also have the liquidity that is equivalent to the large VIX Futures contract because they are dipping into the same volatility pool. So liquidity is not an issue there. When I look at them throughout the trading day, the first couple of months always seem to have a one-tick spread. You see the same thing in the big contract. And finally, all levels of traders are a little bit more comfortable taking a short position using the Mini VIX Futures contracts versus using the old school big VIX Futures contract. So with that, I'm Russell Rhoads, and that's your Volatility 411.